Good afternoon, everyone. My name is Venkateswaran, and I'm delighted to welcome you all to the 26th NYU Stern Economic and Market Outlook Forum. The host of today's forum is the NYU Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as students and alumni. We're pleased to have in the audience today students and faculty from all over NYU, as well as many of our distinguished alums. Thank you all very much for joining us. Today's session will last about 90 minutes. It will begin with short presentations of about 10 minutes each by each of the panelists about their economic and markets outlook, followed by Q&A. We'll finish by 6:30. To ask questions, please enter them through the Q&A feature in Zoom, the Q&A button that you can all see on your Zoom windows. In moderating the session, I will try to limit repetition by grouping questions together and then presenting it to the panelists as kind of broader themes. Given the time constraint, I apologize in advance that we may not be able to get to all the questions. With the administrative details out of the way, let me now turn to introducing our distinguished panelists. In alphabetical order of last name, I'm going to start with Ms. Tricia Hazelwood. Tricia is the head of Global Markets Americas and joined UBS in August 2023. She's a member of the Global Markets Management Committee and chair of the Global Markets Americas Management Committee. Before UBS, Tricia spent over 10 years at MUFG, where she developed and led the firm's global structured products business. She was also a member of the International Management and Risk Committees at the firm. She also spent 16 years at Credit Suisse, with her most recent role as the global head of asset-backed securities, which included the origination and distribution of all USD asset-backed securities products. Prior to that, she spent 4 years at Salomon Brothers in the M&A business in New York, Sydney, and Hong Kong. She graduated from Flinders University of South Australia with a bachelor in economics and organizational psychology. Tricia, welcome to NYU. Our next speaker is Subadra Rajappa. Subadra is the head of U.S. rate strategy at SocGen. In her current role, she's responsible for publishing thematic research on U.S. rates markets and highlighting relevant trading opportunities. She's a frequent speaker at industry conferences and broadcast media, where she presents her views to a very broad audience. She has over 20 years of experience in the financial industry. In her previous role at Morgan Stanley, she was a senior rate strategist focused on macro themes. She was also the lead strategist covering a range of products and presenting in-depth research in fixed income derivatives, inflation, money markets, and the evolving regulatory environment. She has extensive experience in global fixed income markets, including positions in research, sales, and quantitative analysis at Morgan Stanley, and before that at Citigroup. Subadra, welcome once again to NYU. Finally, Nathan Sheets is the global chief economist at Citi Research. Prior to his return to Citi a couple of years ago, Nathan was chief economist and a member of the senior investment team at the asset management firm PGIM Fixed Income. In his policy role, he has served as the Undersecretary of the U.S. Treasury for International Affairs, representing the U.S. government on a number of important economic issues and negotiations. He was also the director of the Division of International Finance at the Federal Reserve Board, a senior advisor to the U.S. Executive Director of the IMF, and a visiting fellow at the Peterson Institute. He holds a PhD in economics from MIT. So with that, I'm going to invite the panelists. So I'm going to start with Nathan and Tricia, followed by Subadra. Nathan, whenever you're ready, take it away.
All right, very good. Thanks so much for that introduction, Venky, and it's great to be here to share a few thoughts. What I plan to do is to kind of give you my take on recent global developments and the global outlook. And I'm going to organize around 5 key themes. I think the place to start, the first theme, is the word resilience. When you step back and think about where we've been over the last 5 years, the global economy has really absorbed an extraordinary range of shocks. The pandemic, the lockdowns, the broken supply chain, surging inflation, Russia, Ukraine, and all of those challenges, central bank rate hikes that were as aggressive as anything we've seen in decades, challenges in the Middle East, and the list goes on and on. I think more recently you could add to that the shift in U.S. policies as a result of the election. But notwithstanding all of this, challenge and all of these headwinds, the global economy has continued to grow at a solid pace. By our reckoning, over the last couple of years, global growth has come in at about 2.75% against a 3% global trend, so just a little bit below trend. But given all these headwinds and challenges, we'd consider that to be a solid, maybe not spectacular, but solid. Another way to frame that is each of these last 2 years, as we've entered the year, we'd say, the global economy is going to slow. It's going to slow. And it just hasn't. And we spent 2023 and 2024 marking up our expectations for what performance would be. So resilience has been a key word. The second key theme I want to put forward here is that of normalization, and specifically normalization post-pandemic. And you recall during the pandemic, there was a surge of demand for goods that led to broken supply chains, very rapid rates of goods inflation, and lots of challenges in the goods sector. Then coming out of the pandemic, there was a massive rotation of spending, particularly for consumers, but more broadly, of spending into the services sector. People had gone several years without traveling, going on vacation, engaging in leisure and hospitality experiences and the like. And they wanted to do this. It was sometimes referred to as revenge spending. And as a result of that revenge spending, we saw an upward surge in services inflation. This in turn brought forth that very aggressive central bank hiking cycle that I described, and created a lot of challenges for the economy and for central banks. The good news is that the displacements, the revenge spending is playing through. Central bank rate hikes have had an effect, and inflation is coming back down to a more normal kind of pre-pandemic level. And that in turn is allowing central banks to move their policy rates to levels that are less restrictive. I don't know if in 2025, most central banks will get back to neutral, but we do expect there to be rate cuts in many different countries, and at least some of the central banks, for example, in Europe, are likely to get back to neutral during this year. So that second word is normalization. Third phrase here that I want to put forward is U.S. exceptionalism. So if we've been surprised by the overall global economy, we've been just downright shocked by the performance of the United States. Again, each of these last couple of years, we've said, the U.S. is going to have a recession, U.S. is going to have a recession. And in the event, the U.S. economy has continued to actually grow well above trend. And I think like many, we've had to kind of step back and say, what's going on here? We see two key engines of growth in the United States. One, the consumer sector, and especially the top 40% of the income distribution that are enjoying very strong balance sheets, favorable wage gains, favorable employment prospects. But the rest of the wage distribution has continued to spend as well. The second engine of growth for the U.S. has just been a very competitive corporate sector. U.S. corporates have continued to grow their earnings. They've been innovative. And as a result of this, the U.S. has, in recent years, I think it's fair to say, we can debate this, but by my reckoning, has won the battle for global capital. And I think you see that in U.S. financial markets. So if this U.S. exceptionalism has been about the economy, arguably it's also been about the performance of markets as well. This then brings me to the fourth theme, and this is one that we're all talking about, and we'll probably spend a fair amount of time discussing in the Q&A. That's the word uncertainty. And specifically, the change in U.S. policy as a result of the presidential election. And I think a key thought to bear in mind here is that President Trump was elected by the American people to be a change agent and to disrupt the status quo. And that's exactly what he's doing. Now, in no sphere do I think those uncertainties are larger than in the sphere of tariffs. And I'm not going to go into tariffs in great detail, but let me just cut into it briefly in one way, kind of one perspective on it. And that is, I think, in Trump's domain, that tariffs are seen as doing three different things. And you can kind of categorize the various tariffs that have been discussed. You can kind of categorize them into one of these three bins. The first one is as a negotiation tool. And I think that's very much what's going on with these threatened tariffs on Mexico and Canada. I don't think it's so much about putting tariffs on Mexico and Canada. It's about having them help the United States secure the border, and that's the ultimate objective. So the first use of tariffs is a negotiation tool. The second I see as being more debatable, but they see as a way of addressing sustained trade and external imbalances. And here I think the threatened tariffs on Europe fall very much in this category. What did Trump say? Trump said they're treating us very, very badly. Why? Because they've run sustained current account surpluses and trade surpluses with the United States. So I see the European tariffs, to the extent we see them, falling more in this category, in China as well. And then the third category of tariffs are those that are primarily designed for revenue. And I think to the extent that we see these kinds of tariffs, they're likely to come in the reconciliation bill later this year, and are likely to be across the board in nature. But like many, we're watching these developments in the tariff space closely. Now, my fifth and final theme, which is kind of wraps this all up, is notwithstanding these uncertainties that I've discussed and some of the other challenges, I would characterize my outlook for the global economy for 2025 as one of tempered optimism. And the rationale for that, I will come back to exactly where I started. And in recent years, we've seen the global economy absorb a lot of shocks and challenges. And are there challenges afoot this year? Absolutely. But I think we've seen a flexibility and a capacity of the global economy to rewire itself. And I'm comfortable that that will continue in 2025. The upshot is that my global outlook is one broadly similar to the last several years, where global growth is around 2.75%, just a notch below trend. Final thought as a corollary to that, we've got to be attuned to the uncertainties and challenges that are out there from geopolitics and politics and policy. But I think that ultimately performance this year, and certainly over the next several years, will be primarily determined by macro fundamentals. And I try to spend a lot of my time talking and thinking about where is the economy in terms of its underlying fundamentals. And that's kind of the source. If the uncertainty is why it's tempered, the fundamentals are why I'd characterize my view as optimistic. And with that, I'll wrap up and give you back the floor, Venky.
Wonderful. Thank you so much, Nathan. So Tricia and Nathan, you can turn your camera off, and then once the Q&A starts, you can bring it back on. Tricia, the floor or the screen is yours.
Great, thank you. And thanks for having me. Unlike my two colleagues that are here today, I am not a technician. I run global markets. I live in the moment. My comments will be based on what we're seeing in the moment. And running global markets, I look after equities, fixed income, including FX. So my obsession at the moment is FX. So I will have a little bit of a bent on that topic today. So yes, total shockwaves with the tariffs, obviously, sort of dovetailing into the comments you've already heard. It wasn't that there were going to be tariffs. They were well communicated. What we were surprised about was the size of the tariffs on Canada and Mexico, less so on China, of course. And so as a result of this, we totally expect some more volatility throughout the year. My remarks will not just cover the broader markets today, but also sector-specific impacts. And importantly, as I mentioned, the effects of FX, which are critical to global markets and also investment flows. So let's start with sort of the immediate market reaction. So the initial response to the announcements was swift and pretty severe. Stock markets worldwide fell sharply, with the major indices, which we also saw in Germany, France, the UK, dropping about 1%. In the US market, the Dow Jones and also the S&P futures indicated losses around 1% to 2% on the news, which I guess was no surprise. And these declines reflect concerns about higher input costs, the reduced earnings from multinational companies, and the potential retaliatory actions by affected countries, which we've seen that in the last couple of days as well. A lot of news about that, and we just mentioned Europe, which is a big concern also. So commodity prices also reacted very strongly. It's another big sector that we look after, and oil prices surged as investors also thought that supply chain disruptions and geopolitical tensions would be an ancillary sort of a effect of these tariffs as well. Meanwhile, base metals such as aluminum, I have to say it that way, my home country I would have said aluminium, but aluminum and copper fell due to concerns about declining demand in industrial sectors that will affect high production costs. So let's go back to those sector specific issues and where we focus, mainly because we are highly concentrated in the equity market. So automobile industry, you've seen the decline in the share prices of some of the major automobile companies. And that's given the integration of supply chains across North America. Automakers are particularly vulnerable. Companies with manufacturing plants in Mexico, including major European and Japanese automakers, will see their production costs rise significantly. Consumers could see vehicles, for instance, increase by $1,500 to $3,000 per unit, and that will dampen demand. So that is the concern that you're seeing coming through in the equity markets. Also, consumer goods. Companies such as Diageo, which import goods from Mexico and Canada, are likely to experience substantial financial strain. Retailers are also warning of price hikes across a wide range of consumer products. You've seen that in all the papers, including the Post, over the last couple of days, which could slow spending and also have increasingly inflationary pressures, which is a concern that we'll talk about in a minute. Technology and electronics, I'm sure that's a major concern for everybody in the audience about those prices going up, but many electronics, including semiconductors and key components for consumer devices, are sourced in China. We all know that. The 10% tariff on Chinese imports could force tech companies to either absorb higher costs or pass them on to consumers, probably the latter. And agriculture, this was a big issue for the last tariff impact that we had. The US agricultural sector is also bracing for the retaliatory tariffs, especially on soybeans, corn, and pork. And as I mentioned, the previous rounds of tariffs led to sharp declines in farm incomes, and we expect similar in this round as well. So let's just look at foreign exchange markets, which is sort of my interest at the moment. We all have been talking about, I think, every major house has been talking about the strengthening of the US dollar. That's definitely true. The foreign exchange markets where global currencies are traded have seen a sharp movement in response to the trade uncertainty. The dollar, of course, has strengthened following the tariff announcements, and investors view the US as a relatively safer market, particularly as interest rates remained elevated compared to other economies. And however, a strong dollar not always is a great thing, because it does pose a risk on our US exports, making them more expensive and could further widen the trade deficit, which we've also been hearing about the last couple of weeks as well. So the guys, I guess, that suffered the most over the last couple of days, obviously, has been the Mexican peso and the Canadian dollar. They've weakened significantly. The Mexican peso fell 5%, Canadian dollar 3%, reflecting those concerns about higher tariffs will slow their domestic markets. Tariffs in Canada are expected to slow GDP growth, particularly in the energy and the auto sectors. You've also seen weakness in the Chinese currency, but remember, we've been having holidays in China at the moment, so I'm not sure that we've seen the full impact of these tariffs, and also I guess there's going to be a lot of negotiations. But the Chinese currency depreciated against the dollar, moving closer to the critical 730 per US dollar level. China may further allow currency depreciation in a way to counteract some of these tariffs by making exports cheaper. I think that's something that we're all aware of and focused on as well, to see their reaction to the tariffs on their economy. Emerging market currencies have also been under a lot of pressure. You would have seen that the Brazilian real, the South Korean won, and also the South African rand have all depreciated as investors have anticipated lower global trade and lower demand for commodities. The net beneficiaries have been those safe haven currencies such as the Swissy, I'm not just saying that because I'm at UBS, that has actually been a net beneficiary, and also the Japanese yen. The Japanese yen has appreciated nearly 2% against the US dollar as investors are seeking refuge in those safe currencies and safe economies. And Japan is a very, very stable economy. As you know, no surprises, well, risk aversion, you move to Switzerland, and we've seen that. So if we look at the broader economic projections at this exact point in time, and obviously these are subject to change, and I'm looking at a broad range of economists, not just the ones at UBS, we have seen economists predict that these tariffs will have long-term consequences on economic growth and inflation. And that inflation is something we're really monitoring. So US GDP growth slowdown. Over a range of analysts have expected US GDP growth to slow down by at least 0.2% to 0.3% in 2025 as businesses adjust to high input costs and weaker export demand. On the higher inflation, with import prices rising, the inflation in the US is expected to move above 3.3. And to just give you some sort of view of what that really means, that would be the highest level since the 2008 financial crisis. So that is a big focus point for us in the markets. Corporate profit declines are also a concern. S&P companies may experience what has been viewed as, and this is by a range of economists, not the UBS economists, an 8% reduction in potential profits due to the higher costs and disruptive supply chains. And then job losses. The Tax Foundation estimates that 142,000 jobs could be lost due to reduced economic activity. And that's before we put on potential job losses from AI, which I think also has been well telegraphed recently. So what does this mean for investors? Well, first of all, we can expect stock market volatility. You've seen it over the last couple of days. Investors should prepare for continued volatility, particularly in those industries most affected by tariffs that I mentioned before, such as autos, consumer goods, and manufacturing. The commodities outlook is also interesting. While oil prices, they do have remained elevated, industry metals like aluminum and steel could remain under pressure if global trade slows. Currency market strategies. Exporters should hedge against a stronger US dollar, obviously, but that does reduce competitiveness. So that's something that we're also looking at. And investors are looking to buy yen, Swissy, and also gold. We've seen a lot of movement in gold, especially in the US over the last week in particular. The bond market considerations are something that we're focused on. I think, earlier, at the last part of the year, we were thinking, potentially 4 rate cuts. I think most people are thinking there will be max 2 at the moment. With rising inflation, the Fed might be hesitant to cut rates aggressively. We think that's highly likely. And however, if economic conditions worsen, bond yields could decline as well. So that's something to, remain thoughtful about. So in conclusion, the newly imposed Trump tariffs, they have set the stage for a turbulent 2025 with wide-reaching effect across financial markets, the corporate earnings, and also global related trade. The FX markets in particular are reacting sharply with the US dollar strengthening, emerging markets struggling, and a safe haven currencies gaining ground. And as we navigate the coming months, businesses and investors, I think what we're suggesting to everybody is to remain very agile. It is a fast-paced moving market at the moment. Trade policies obviously could shift rapidly. We've seen the news in the paper about different strategies, and I think we were just talking about some in the previous comments as well. And the market will continue to react both to economic data and also political development. And while the risks are pretty evident here, the opportunities also arise for a lot of the market players who can adapt in this changing market landscape. So a lot going on in the markets. It's very interesting times. And I managed to talk about that without really only mentioning AI once, but we could have another 30-minute discussion about what's going on in that market as well. But with that, I'll hand it back to you. Thank you.
Thank you so much, Tricia. That was kind of a very good overview of lots of things. So I'm sure we'll get back to some of those themes in the Q&A. Again, just to remind everyone, please continue typing questions into the Q&A box, and I will keep filtering them, or I'll keep reviewing them as the session progresses along. Our third panelist is Subadra Rajappa. Subadra, all yours.
Thank you, Venky. And like Tricia, I started my career at Salomon Brothers, so it's always nice to meet a alum virtually. I think I'm going to be different from the other panelists. I'm going to share some of my slides. Sorry, I'm losing my voice a little bit. Really, what at least the bond market, which is my main area of focus, has experienced is a bit of a stasis. And I think Tricia was talking about that towards the end of her overview. And what you're seeing, and kind of moving on to the next slide, is that there's a bit of a tug of war, if you will, in the 10-year bond yield between a build-up in term premia, because the bond market especially is looking at a trajectory for debt and deficits that look quite dire over the next 10 years. And so you're seeing a bit of a term premium. So you're seeing that tug of war, a pull towards higher yields. And on the other end, you have the whole tariff story and inflation and the impact of that potentially leading to lower growth. And that would mean lower long bond yields. So ultimately, I think between these two forces, you're seeing 10-year yields stuck around that 4.5% level for a good portion of the first month of the year. This is a really unusual easing cycle. If you look at the chart on the top, typically bond yields decline as the Fed starts easing. Last year, they delivered about 100 basis points of cuts. And guess what? The 2-year to 30-year bond yields actually rose anywhere from I'd say 75 basis points to around 100 basis points, which is quite unusual. So we're now looking at a very modest pace of easing, as very similar to what we saw back in the 90s, where the Fed had to ease just a few times and then keep policy on hold for an extended period of time during the 90s. And the path of the 10-year yield is very similar to what we saw back in the first Trump period, where the risks of inflation drove bond yields higher. So moving on to the next slide, what you're really seeing is that the market has priced out cuts for this year. I mean, coming into the year, I think our expectations, similar to what Tricia was saying, was for 4 cuts. We now think that the Fed's going to deliver just 2 cuts, and the market's really very efficiently priced for that scenario. But really what stands out to me is that even though the market has priced out cuts, if you look at the broader financial conditions remain extraordinarily accommodative. You're looking at an equity market that's at historical highs. Credit spreads are extraordinarily tight. Of course, as Tricia was mentioning, the dollar's strong, and policy, again, at least the bias from the Fed is towards easing. So that I think easier financial conditions broadly is supporting the markets overall, and you're seeing that play out in kind of the strength and economic fundamentals as well. The market is pricing in some probability of a hike, but really, if you look at the broader distribution of probabilities, what the market has priced out is the probability of a recession. So nobody in the market at the current time is really talking about the potential for a recession. So moving on to the next slide, if you look at really the progression of 10-year yields, and if you were to break out the movement in the 10-year yields over the last, I'd say since September of last year when the Fed started easing policy, a lot of the move in 10-year yields has been because of a rise in term premia. So, and that has been, I would say, mostly because of the outlook, the fiscal outlook. If you look at the sort of the projections that came out of the Tax Foundation, as well as some of the other think tanks on the trajectory for debt and deficits, the expectation for the trajectory of deficits is quite steep under the upcoming, expectations, I should say, for the Trump administration. And moving on to the next slide, I mean, another thing that the market's been pricing in is a much higher terminal rate. So there are many projections for where the terminal rate is or where R* should be. And the market, at least collectively, is thinking that this time around, the terminal Fed funds rate is going to be a lot higher than what we've seen historically, and a lot higher, I should say, than what the Fed has penciled in for its long run Fed funds rate. So, the terminal Fed funds rate that the market's looking at is somewhere between 3.75 and 4%. So we're looking at really a very benign easing cycle. And then moving on to the next slide, another factor that's been driving bond yields higher is the stronger dollar. Typically, the dollar tends to be a lot more correlated to front-end yields, central bank policy, or where, say, the 2-year Treasury yield is. But as you can see from the chart on the top right, the 10-year yield is much more correlated to the dollar as opposed to the 2-year yield, which is much more pegged to Fed expectations. And then you have to kind of factor in the demand for treasuries. And that's where you see that a lot of the demand for treasuries is coming from the domestic investors, whether it be hedge funds or real money accounts. Foreigners, broadly speaking, are not buying nearly as many treasuries as they have in the past. I mean, China has been buying, if anything, reducing its treasury holdings. Japan is not buying nearly as many treasuries because domestic interest rates in Japan are rising, with the Bank of Japan actually hiking. Actually, the one central bank that's been hiking policy and we're expecting that they'll actually deliver more hikes during the course of this year. So the demand from foreign investors for treasuries has also been quite tepid, and that's been a factor pushing yields higher. So kind of the way, at least moving on to the next slide, the way we look at our projections for 10-year Treasury yields is that in our base case, I think the Fed delivers maybe 2 to 3 cuts for this year. In this sort of scenario, I can actually see 10-year yields staying between, somewhere between 4 and 5% for the rest of the year. But a scenario that we're watching very closely, and I've highlighted here in yellow, is a bear case scenario where, if there's sort of concerns about tariffs and higher inflation starts to come into play, then the Fed might not have to cut rates. If anything, they might have to think about hiking policy, perhaps. And in that sort of scenario, I can see a push for 10-year yields towards that 5% level. But that, in turn, could be a buying opportunity. So quickly kind of moving, I'm going to kind of push forward to, I would say, if you could kind of move to slide, I'm trying to see what the number is, slide 11. The slide before that. This gives you a quick idea, the slide after that, slide 11, sorry. Yeah. This gives you a breakdown of what we can expect under the Trump plan. There is going to most likely be an extension of the Trump tax cuts, or the TCJA, which is the first line on this page. And you can see that extension of the Trump tax cuts is going to add roughly about $5 trillion in deficits over the next 10 years. And, the new Treasury Secretary Bessent has said that that extension of the tax cuts is almost, if you don't have an extension of the Trump tax cuts, that's going to be catastrophic. So it's almost a given at this point that, by way of reconciliation, they might have to pass the Trump tax cuts, and that's going to increase deficits by around $5 trillion. And a lot of the other line items that Trump promised during the campaign, no tax on tips, no tax on overtime, et cetera, et cetera. I think all of these other line items, at least in my view, are less likely, given the fact that it's going to contribute. The deficits are already quite large and are expected to and should increase by around $5 trillion with the extension of the Trump tax cuts. And one of the offsets to those is going to come from revenues from tariffs. So that revenue side of the equation we're looking at is roughly around 2.7 trillion. And that's kind of looking at it quite generously over the next 10 years. So, the cognitive dissonance, if you will, in some of the conversations I've had with clients is that most clients think that the tariffs are going to be a negotiating technique or tactic, I should say, for the Trump administration to come up with some sort of a deal with its trading counterparts, whether it be Canada and Mexico on fentanyl and immigration, or China, where there's some sort of an agreement being or a deal being made to try to bring industry back to the United States. And if that were the case, then kind of seeing this line item of tariffs being a source of revenue kind of is kind of opposite to what you would expect in a negotiated deal where there's no tariffs. So I would think that ultimately, when the dust settles, the Trump plan is going to involve some tariffs, perhaps from China, which have stayed on. And if you recall, he imposed tariffs between the 2016 and 2020 timeframe, and the Biden administration kept those tariffs because it was a source of revenue to offset some of the expenditures that were being put forth over the last I'd say 10 years of increase in deficits. And so that's something I think that ultimately, even though there are going to be some deals to be had, I think that some of these tariffs, at least with China and potentially Europe, are likely here to stay and are going to be a source of revenue that the Trump administration is going to look at over the sort of longer run to offset some of the expenses on the tax side and the deficit side. And then you have to kind of look at the Department of Government Efficiency, run by or DOGE, now headed by Elon Musk. Again, it's not clear to me what the efficiencies are going to be on the spending side, because there's really very little by way of non-defense discretionary spending that is available for Musk and team to work on to cut deficits. So it's going to be really interesting to see what they can do there to reduce deficits. I mean, to me at least, I mean, the $2 trillion number that Musk mentioned during the campaign might be a very high bar. Getting to even $1 trillion might be quite hard. Maybe they are able to reduce maybe 200 billion to 500 billion in deficit spending. That still leaves us with the trajectory for debt and deficits that's quite dire over the next 10 years. So to me, that would mean perhaps a push towards higher term premium and higher yields, and that is yet to be determined. So I'm watching the developments on the policy front very, very closely to get a sense of what this means for the macroeconomic backdrop, inflation, employment, as well as fiscal spending. So with that, I'm going to pause and turn it over to you, Venky, and the Q&A team to see if there's any questions.
Wonderful. Thank you so much. Tricia and Nathan, if you could turn your cameras on as well, and I will start kind of framing some of these questions. Right. So I'm going to start with one question, that kind of relates to my questions as well, since both Tricia and Subadra talked about exchange rates, and given that that's top of mind for Tricia, we'll go directly there. So the question from the audience has to do with the outlook for the dollar against the euro. I know you touched on that, and I wanted to maybe dig into that a little bit. I want to add maybe two comments of my own, or two comments/questions of my own. The rhetoric from the administration, like perhaps so much else, is a little bit kind of confusing and has a schizophrenic flavor to it. You hear on the one hand that, the administration really prizes a strong dollar, but at the same time, it also is pushing to say, I want, smaller deficits and so on. And the same thing, when you see the same kind of discussion on the tariff side, where today, I think, as one of the audience members points out, Scott Besson talks about how exchange rate movements will cushion the blow of the tariff. In other words, the dollar strengthening might make the tariff less painful. And Tricia, you mentioned how China and other countries might depreciate their currencies as a way of offsetting this stuff. And so there's a lot of moving parts on the exchange rate side. And so one question would be, and kind of at a broader level, is this a major theme? Or is this kind of, are we entering a new territory for exchange rates where trade policy and these kinds of things are much more important than perhaps even, fundamentals like interest rates and this thing? Is this something is this a new source of volatility and a new source of driving forces in exchange rates? I'm going to start. Tricia, you can take the question first, and then I'll let Nathan and then Subadra in that order.
I mean, I think there's so many parts to that question. So, I'm not the FX strategist at UBS. If I was going to pick a number for the euro, it's possible to 95. It's just, you see the US and we were talking about American exceptionalism. I think when you travel, you hear that word all the time. I was in Brazil last week and I was in the Middle East before that, and we hear that a lot. And just the growth prospects for the US are so strong. And we haven't had an AI theme to this panel, but we probably should follow up your next panel on that, because there's so much to talk about with that, especially with DeepSeek last week. So, I definitely think it's part of the analysis, just with the strengthening of the US economy, and the strengthening of the dollar. But it's not all positive. As I mentioned, it does make our exports a lot more expensive. And so, it's a pull and a push. So those things probably will be a little bit of a negative as we move through this phase. And that's why a lot of, economies don't want to see their currency appreciate so rapidly, because it actually ends up being a bit of a drag on their deficit. So, that's something that is concerning. But obviously, for everybody that's thinking of spending their spring break in Europe, it's probably a good thing. But outside of that, I think that this is something, especially with how the Chinese are going to react, is something that we're going to watch. And we don't want to talk about really currency manipulations, but it's going to be very interesting to see how they react to the tariffs.
Two quick thoughts there in response to your excellent question. First of all, many of the metrics that I look at for the dollar indicate that the dollar, this is a very strong dollar. Arguably, it's the strongest dollar that we've seen since the 1980s. And I think that reflects the fact that the U.S. economy has been relatively strong, especially versus other DMs. It reflects that the Fed has been relatively aggressive, and it reflects the ongoing demand for U.S. assets and a bit of that exceptionalism that I described. And when I extrapolate things forward through 2025, it still feels to me like the U.S. economy is likely to be somewhat stronger than other parts of the world, particularly, again, in the DMs. If I follow the market pricing, the Fed is going to cut, but probably not as much as other major central banks. And as you pointed out, Trump's policies seem more likely to be dollar positive than dollar negative. So I think over several years, we will see a weaker dollar. Over the near term, I have a hard time getting my head around that. Now, the dollar's so strong, I don't want to say it's going to strengthen further, but I don't think it will reverse. And specifically on the euro, it wouldn't shock me if in the next 6 months we saw parity. Again, in the fullness of time, the euro will bounce back up, but I wouldn't be surprised to see parity in the near term. And then the other point, and I'll try to be really brief here, is kind of the equivalence between exchange rate appreciation and tariffs, so the implications of exchange rate appreciation for an economy that's experiencing tariffs. So first of all, you put on tariffs, it tends to generate an appreciation in your currency. Secondly, what are the macroeconomic effects? Well, when I put on tariffs, it tends to put upward pressure on prices. People have to pay more, imports are more expensive, and downward pressure on real GDP. Why? Because it's a tax particularly on consumers, maybe secondarily on exporters, but primarily on consumers. There are less real income, and you have less spending and less GDP. When the currency appreciates, it will help offset some of those price pressures. And that is an antidote to the effects of the tariff. But concerningly, it would reinforce the appreciation of the currency. It's a drag on trade, it's a drag on competitiveness, and it's going to reinforce some of that economic weakness. Now, maybe that then opens the door, makes it a little easier for the Fed to cut, because they don't have to worry so much about prices. They can just focus on the economic activity implications. So there is a sense in which the appreciation addresses, but there's also a sense in which it reinforces concerns associated with tariffs. A lot of other dimensions we could go into, but I'll stop there.
Yeah, no, I agree with what Nathan was talking about, which is, I'd say the big key difference between now and the period between 2016 and 2020 was that one, tariffs were on, sort of a very small, limited scale relative to what we're looking at now. Back in the 2016-2020 period, we were not looking at 25% tariffs on Canada and Mexico, and we were not looking at 60% tariffs on China. So the sheer magnitude of the tariffs this time around are quite large. The second thing was that for the most part, the US consumer did not really feel the pain of tariffs because you saw a commensurate appreciation of the dollar. Now we're already starting at a point where the dollar is extraordinarily strong. And it's not clear to me how much more, yes, there's US exceptionalism. Yes, we're a much more productive nation. Yes, we have, AI advances and we're well ahead of the world in all of these different areas. I don't know how much more in practice the dollar could strengthen relative to, all the other global currencies. I mean, for instance, when I talk to China's economist, she says, well, you know what? China's not going to let the yuan get above 7.5 to the dollar, right? I mean, it probably doesn't even get to 7.5. So the countries don't want to see their currencies continue to depreciate versus the dollar. So I would think ultimately this would mean that the brunt or the burden felt by the U.S. consumer this time around could be a lot more. And then you are talking about the potential for retaliation, trade wars, currency controls, and then you have a whole other discussion we can have for another 2 hours on what the issues could be on all of those fronts. So that, I mean, to me, those are the two key differences that I'd like to kind of highlight between what we experienced, in the first Trump administration and now.
Wonderful. Thank you so much. So I'm going to kind of move to a different set of questions. So Dick Berner, who I suppose all of you know, says, so he has a question about why do you think President Trump wants a sovereign wealth fund and what is its feasibility? And there's another question about the sovereign wealth fund from about to get your thoughts on the potential new sovereign debt fund and exactly how that would work out. I want to kind of add like a small kind of addendum to that, and I'd love to hear your thoughts on that. Whether or not the sovereign wealth fund, whatever that idea is, whether that kind of materializes or not, we're certainly entering an era where the US government is not going to be shy about putting its thumb on its scale with respect to certain industries and perhaps even certain companies over others, right? So that's the new normal. And this perhaps predates Trump, at least in recent history, but it's certainly going to be something that President Trump is going to use with much more, vigor, right? And what the question I wanted to ask in some sense was, how do you see this affecting the market outlook? Is this about volatility? Is this really something that is actually buttressing, US exceptionalism? Because there is we used to talk about the Fed put. Now we're going to have a Trump put, I guess, on the stock market. And so is this, another thing which is kind of putting up or propping up, at least in the short to medium term, US markets or US investments relative to the rest of the world? And again, maybe this time, just to mix it up, I'll go Nathan, Subadra, and Tricia. Subadra, I know this is a little bit outside the rate space, but this is a safe space. You can speculate at will.
Well, consistent with that license, let me do a little bit of speculation about the sovereign wealth fund. I really think that the attractiveness of this is to give the executive branch, to give the president, to give the Treasury another dimension of flexibility and degrees of freedom in the formulation of policy and achieving their objectives. And it's important for me to say here and to emphasize that Trump has put this forward, but a sovereign wealth fund was also very much being considered during the final year of the Biden administration as well, I think for broadly similar reasons. And if I had to put a label on it, I think I would call it more industrial policy. It's kind of picking and choosing, various places to invest, various sectors to support and help. Maybe, as you say, maybe we'll get as narrow as specific firms to provide support to. I would personally get a lot more nervous if it evolved to the point of kind of market stabilization. And the sovereign wealth fund was actively intervening, for example, in the equity market. But I mean, all of these are risks on the table. Now, let me just make one final remark here. And really, right now, as close to a sovereign wealth fund as the United States has is the ESF, the Exchange Stabilization Fund. And you think back how over the last 15 or 20 years, the ESF has been used, including during the global financial crisis and elsewhere. It has been used in a flexible way to support economic policy, maybe over and above its explicit mandate of holding resources for foreign exchange intervention. And so I think of the sovereign wealth fund as expanding the flexibility and probably funded at a scale that's an order of magnitude larger, although exactly where the funding comes from, no one knows. And the question of feasibility looms very large here.
So, I mean, I don't really have a whole lot to say on this. I mean, I meet sovereign wealth funds in other parts of the world all the time. And where they invest primarily is in the US, in the stock market, bond market. So this is kind of a new thing to kind of, for me to wrap my head around having to, like US having a sovereign wealth fund. The thing with tariffs is that the government does kind of get to pick winners and losers, right? The policies are such that you are going to, by way of tariffs. I mean, last time it was specifically steel, aluminum. So there were some specific industries that tariffs were targeted towards. So my concern is that with the sovereign wealth fund, in some respects, the government might be able to do the same thing. I mean, in his initial comments, Trump is talking about using the sovereign wealth fund to buy TikTok. So the mandate seems to be a little bit broad, and perhaps it's still in its nascent stages, but I can't say that I have a full sort of understanding and handle on what the purpose would be for a sovereign wealth fund.
Yeah, I think the same sort of issues. Obviously, we need a little bit more detail about the sovereign wealth fund, and there's a lot of very successful sovereign wealth funds that have been used to create generational sort of wealth in countries, and so I think there is an absolute value to them. I think the question, and it was just raised before, is like, where does the money come? So when you put any fund together, you got to have money to invest. I think the view has been that maybe the money will come from the tariffs. So, okay, let's put that as one source of revenues, because obviously, with deficits, you don't have surplus revenues to use for a sovereign wealth fund like some other countries that have massive sovereign wealth funds have a lot of surplus revenue. So they're using that to invest. So we don't have that here. So we're going to have to find the money. I think the other interesting idea that has been thought about is, should we be looking at selling some of the assets, the, government assets, to also fund some of the money for the sovereign wealth fund? I come from Australia, and the government did do a lot of privatizations, some positive, some maybe not as positive in that country. We can say there's some efficiencies in doing that, but also there becomes some costs over time that sort of need to be thought about as well. So say you get the money for those things from those two sources as a starting point, then what do you use the money for? And I think it would be interesting if they could use it for infrastructure projects. Once again, outside of the US, the infrastructure market has been pretty buoyant, both in Europe and in Asia and Australia, where they've been used for projects to provide sort of funding for the obvious thing, which is roads, but less obvious airport privatizations and growth. Power generation as well. So I think there's a lot of interesting opportunities here that need to be sort of thought about. So I'm sort of positive on the idea. I guess it just needs a little bit more sort of meat on the bones.
Great, excellent. So I have another question, which I think maybe relates, is a good, nice follow-up to this discussion. So as all of you in various stages in your overview and in your Q&A responses talked about the looming deficits and the fiscal situation. So the question I wanted to ask, slightly unfair, but you guys can handle it. There's a sense in which I've done these forums for a while now, and there's a sense in which we are all contractually obligated to talk about the deficit for a few minutes, and then we go back, and then it's kind of business as usual, right? And then we just say yes. So, but what else are we going to do with the money? We're going to buy U.S. Treasuries anyway. And I wanted to kind of get a sense of is there a feeling from your interactions with market participants and perhaps your own thoughts that there is something that the problem is perhaps grown to a scale where this might actually have a consequence. And I'm going to start maybe, or is there a sense in which this time it's different? Is this really when we are paying attention to the fiscal situation besides paying lip service to that? So I'm going to start as the representative of the bond market. Subadra, I'm going to start with you. Then we go to Tricia, and then we'll give Nathan the floor.
I was going to say it's in my contract to talk about deficits. Kidding. No, I mean, I think that this is the number one question I get asked, in every meeting that I'm going to, which is at what level in 10-year yield should I really be concerned about, deficits in the U.S. and is our 10-year yields going to go to 6% at some point or 7% because of looming deficits? And my answer is always that, honestly, with the fact that we're a reserve currency and there's just always kind of a demand from a diverse set of market participants, broadly speaking, I would say that, unless we have some sort of a crisis of confidence, I don't really see a deficit-led situation that's going to cause 10-year yields or treasury yields to, kind of rise, to levels out of control. I think for the most part, it feels to me that we're still the largest economy. We're the reserve currency. We've spent a lot of time talking about U.S. exceptionalism. So this is still the best sort of country to invest in. And we're in some respects we're like the best house in a bad neighborhood, because you look at the trajectory for debt and deficits in all the other countries, all developed nations, it's kind of heading in the same direction. So to me it feels like, yeah, you're going to see a push towards 5% if you see a trajectory of debt and deficits that's deteriorating, especially if over the years we don't really show any resolve to try to rein in deficits. But really kind of unruly rise in yields will come only if there's some sort of a crisis of confidence where people are starting to really worry about the US and the fundamentals for some reason. I can't really envision a scenario that's going to cause a crisis of confidence.
Yeah, and following up from that, I have little to add because I feel exactly the same way. The only two things I'd added just to your comments were, we are seeing a lot of inflows into the US, just that confidence about the US market. Certainly when you look at economies, like Brazil, which is obviously going through some, very tough times with their market, definitely people are looking up at the US and saying, for the next couple of years, especially, while they wait out their elections in 2026, the US is a much more stable economy to invest in. And that's certainly the thought from a lot of other nations as well. I think the other thing with deficits that we just don't know the answer to is, what is the new tax policy, both on the, individuals and also corporations, and how's that going to affect the deficit as well. I think that's another thing that we're waiting to find out a little bit more information on. And I guess there's always Doge. So also waiting to find out what the Doge impact will be. So, more to come.
And I come down in a very similar place to my two colleagues here on the panel. However, let me also emphasize in response to your question that I do think that we have seen an inflection in market concern about the fiscal situation, and particularly the massive issuance that suggests. If you take all those deficits that are expected over the coming decade and aggregate them up, you're looking at Treasury issuance on the order of $25 trillion cumulatively during that coming decade. And the total size of the Treasury market will rise from the high 20s to over $50 trillion over that period. Now, specifically where I think we had this inflection of concern was in late summer and early fall of 2023. And it was around that episode when the 10-year Treasury streaked up to around 5%. And I think that what triggered it was kind of a confluence of three things. First, we were coming out of that very challenging debt ceiling episode. Second, we had the Fitch sovereign downgrade. But then third, and I think this was the one that was really the wake-up call, is you had a Treasury refunding announcement where it was clear there was massive issuance that was going to be needed going forward. And Treasury yields shot up. It was in the context of also the Fed sounding more hawkish. Over the course of the fall, the economy slowed a bit. The Fed started talking a little bit more dovishly. Inflation was coming down. And then in November, in the refunding announcement, the Treasury notably shifted toward more bills issuance. And the markets took that as a signal that Treasury understands the problem and they're in it with us. So kind of bottom line, I very much agree. I don't expect a crisis, but I do think that the markets are more attuned to these risks than they were. And I think that in equilibrium going forward, there is likely to be a Treasury fiscal risk premium that's embedded, which means it will cost a little bit more for the Treasury to issue than what would be the case if we had a more disciplined fiscal position.
Great. Thank you so much. And I think this leads me on to a next question, which I think showed up in a couple of questions as well. All of you, to varying degrees perhaps, presented what I would characterize as a more or less benign outlook for the global economy and for that. To varying degrees. Subadra had a bearish bond market scenario in her slide, so I'm simplifying a little bit. The thing I wanted to perhaps ask you guys to weigh in on is, what are you watching for risk factors that could seriously derail that train, right? Or do you see? Obviously we might experience something we've never seen before, and that's probably where that's where the surprise lies. But is there something you're watching to see? Okay, what could go wrong with this somewhat benign view? I will start. Let's start with Subadra, Nathan, and then Tricia. Yes.
The economy is pretty strong, right? If you look at corporate profit margins, they're pretty healthy. I know employment is still very strong. My concerns are really on, on immigration and tariffs. To me, I feel like, if you look at the last, say, couple of years, a lot of the increase in the job market has come from foreign-born workers. So, to the extent that we start clamping down on immigration, again, the numbers have to be pretty large. That is something that I would be concerned about, because that could mean increase in wages. You could see kind of maybe even like somewhat of a price wage spiral of some sort. So again, this is something that I'm watching. I don't really think that they're going to be able to deport as many as they're saying that they will. But that's something that I think is worth watching. And then tape bombs on tariffs. These tariffs could be quite it's we just don't know what the impact is going to be. And I think that that we could see a meaningful impact on growth if Trump decides to stick with his 25% tariffs on Canada and Mexico, and 60% tariffs on China, although I think that those numbers still look very high.
Let me give you three risks that I'm focused on. I'd say first is Subadra's bear case for rates, that if we do get up to 5% on the 10-year, maybe even a little higher than that, that's likely to have very adverse effects for the U.S. and for the global economy. maybe further stoke that treasury risk premium that I was talking about and cause investors to think even a little harder about whether they want to hold all these forthcoming treasuries. So that's the first item on my list. Second, I would say, something in this whole kind of vector of Trump policies. Probably I'd focus most on tariffs and tariff uncertainty. And I think that's a key. We've got to worry about what effects tariffs are going to have. But as Trump is threatening all these tariffs, does that create uncertainty in places even before he imposes those tariffs? Does that create a headwind, for example, in Europe, where they're very focused? We haven't had the tariffs yet, but trade uncertainty. And in 2018-19, we had a slowing in the global manufacturing sector, and it was attributed to trade policies, trade uncertainty, and the like. And so that would be, there's definitely risks there. And then the third, I kind of concluded my remarks as saying, stay riveted on the underlying macro. And on that one, I'm pretty comfortable with where the U.S. consumer is and what the U.S. consumer sector looks like in aggregate. But we're also in a place where we have seen a gradual migration down in the savings rate. And the savings rate in the latest data was at 3.8% versus a pre-pandemic average of 5.2%. That's during the 20 years before the pandemic. So we're at a relatively low savings rate, which suggests to me that the consumer may be getting stretched. And if you were to have kind of a pullback in consumer spending, maybe in conjunction with some pressures from Trump policies, maybe things could start to unravel. But that's the place I'd point to in the macro space.
Yeah, I definitely agree with my two panelists. I think the thing that I worry about the most is probably inflation and the effects of the tariffs on inflation, and then the effects that will have on interest rates. And, one of the reasons for that is just the cost to corporate America. And when you look at, some of the biggest markets that we've had growing over, since the GFC, we look at the leveraged loan market, we hit over $1 trillion last year. That market obviously is, very focused on interest rates. That has survived very well during the last couple of years with higher interest rates. Interest rates have been coming down a little bit. That definitely benefits that market, but a reverse around where we see higher interest rates puts lots of pressure on the high yield and the leveraged loan market, which has been very has had significant growth, I should say, in the last 15 years. So that's something that we monitor. Obviously, that affects mortgages as well, mortgage rates, the health of mum and dad America as they're looking at buying their house. The credit card issue as well, where we've already seen balances of credit cards starting to move up significantly. So those sorts of things we worry about a lot because it's sort of like the canary in the coal mine. It's those things that start to where we see some I guess, issues of strain and stress. But let me tell you, the other thing that is interesting that you worry about just with what all this information going on, that's the thing I worry about too in the market. There is a lot happening at once. It's a lot to digest. It's the first time that I can remember that we had 2 back-to-back weekends sort of with a lot of information. We spent, the weekend before last really focusing on, what was coming out of China with DeepSeek. And I would say that during the week, the equity markets was so focused on, what was going on in the AI that they were not focused on at all the fact that this looming trade war, and when the macro side of the house was looking at these FX rates changing dramatically, the equities market was completely in denial and had no idea that was going on. So, those sorts of things, as somebody that runs global markets, also worries me. A lot of information, a lot of different things happening at the same time that we have to make sure that we're focusing on all of these issues at once.
Totally great. Thank you so much. That was a great answer from all of you. I think that was very that covered a lot of ground. So one question, and this maybe springs off of what Tricia was talking about at the end. It's hard for me in the outlook and your responses. It's hard for me to see a silver lining for China or a silver lining for Europe in this, right? I mean, between American exceptionalism sucking capital from the rest of the world to the potential for tariffs and all these, and all this stuff. And so, perhaps the sole gleam of light for China was DeepSeek, perhaps, in all of this stuff. And so I wanted to kind of get a sense of, either from the perspective of exchange rates or stock markets in those countries, what your outlook very briefly for China and Europe as the two biggest blocks. But feel free to kind of direct the question in a more productive direction should you flee. So I'm going to start with Tricia, Nathan, and then Subadra. Again, I'll leave that up to you how you want to answer that one. Great. All right.
So I am global head of Americas. So as a result, I don't spend a lot of time on the European and the Chinese market, but I did live in Asia for a while. So my view is sort of super macro, not UBS related. And it's just, the growing wealth in the Chinese population, when you think about it, for many years, it's been a one-child population. So you've got the grandparents with one child and those parents with one child. And you've got sort of this wealth establishment that's happening that I think is quite interesting. At the same point in time, you've got the issue with housing where you've got a lot of houses that are available, they're being rented at prices that aren't probably, where they should be. So there's this massive loss that's occurring there. And how does that get fixed up? So there's a lot of, insular issues in China itself that needs to be fixed. There is no doubt, though, the AI race is on. The DeepSeek thing was a big shot across the bow. We can work out where we think they used different things or didn't use different things. Who knows, right? But the truth is, it's going to be very important for the US government to make sure they stay ahead of that, both for defense and, just for, all the reasons that we use AI at this point in time. So I think those are the challenges. On Europe, obviously they're going through their own sort of restructure a little bit. I think the focus there is going to be what happens also with the Ukraine-Russia war and what the resolution that we're all hoping that we see in the not too distant future is, and how the impact on the spend of NATO can be sort of beneficial. So I think there's a lot of issues that are coming out of the Trump administration for Europe that could be hopefully very positive as well.
Just a few thoughts here for Europe. I think there is a silver lining, and that is when you look at aggregate euro area performance, it's been quite lackluster and unimpressive. But when you look at the individual countries, there's actually been quite a divergence of performance. And on the kind of the challenged end, you have Germany, which over the last 5 years, the German economy in aggregate has grown a total of 0. 5 years growth combined, added up cumulatively, is 0. Very weak performance. Lots of questions about whether Germany is well positioned to meet the challenges of the coming decade and decades. But at the same time, some of the southern services producing economies that are more tourism oriented, like Spain, Greece, Portugal, are doing quite well and are putting in very solid, indeed, meaningfully above trend growth. For Spain, it's in the 2.5% to 3% range recently. And I think these economies reformed following the peripherals pressures after the GFC, and they're reaping some of those benefits. I think they're also reaping benefits from the next generation EU investment program. But it really is a divergence of perspectives and performances in Europe. So you can see that positive story there. I have a harder time telling you what the silver lining is for China. As you suggested, maybe we saw it last week, that there is a lot of innovation and a lot of human potential and a lot of human capital that's in China. I think the challenges there are macro, and specifically consumers are very pessimistic. Consumer confidence in China fell sharply as the pandemic erupted, and it's just moved along the basement over the last 4 or 5 years, a very depressed level. And what's happening is these consumers are looking to the future and they say, gee, the future looks pretty challenged. We see a lot of debt and leverage afflicting the economy. It's not clear where growth is going to come from. President Xi wants it to come from trade and advanced manufacturing, but I don't think China is going to have adequate access to global markets to allow that to happen. Geopolitical pressures are very much in play. Demographics are adverse. So it really is, over the medium to long term, there quite a laundry list of severe challenges that's feeding back into sentiment today and is actually creating headwinds for the economy. The authorities are responding there by putting in more stimulus. They're reluctant to do it, but they're gradually doing that, which then reinforces the debt and leverage issues. So it's a challenging macro outlook.
Yeah, I think both Tricia and Nathan summed it up really well. I mean, China is in the middle of a balance sheet recession. I think the silver lining for China is that Trump's focus is not just on China, but a whole bunch of countries. So hopefully it gives them a little bit of respite, and they feel like they're in good company with a whole bunch of other countries that are going through the same struggles. And for Europe, I mean, Greece is looking, 2012, we were worried about European crisis led by the peripheries. Now, as Nathan was saying, the peripheries are doing really well, and we're concerned about election outcomes in Germany and election outcomes in France. So it's really a peripheries doing well versus the core, hopefully staying stable, which is going to keep Europe somewhat probably better than people anticipate. Overall, I think our economists are a little bit more optimistic than I would be outside looking in, but they're chugging along.
Excellent. So, coming back to contractual obligations, I have to ask you an AI question. So I'm going to try and we could talk for length about this. So I'm going to try and keep it focused so I can get a few thoughts on that. So one thing about AI, which I think keeps coming up in, perhaps in the background, sometimes more to the foreground, is this really an engine of, is this really a growth engine? Is there a fountain of growth this is going to unleash? And that's obviously of great importance for, market performance, but it's also very important for thinking about R* and where we're going to settle down in terms of long run rates. So there are various facets to this. And I agree, we're in wildly speculative territory here, but I wanted to kind of get your sense of how thinking on that has evolved over the last year, in the AI era, which is all of a year and a half, maybe, and kind of get your own thoughts. You can, feel free to kind of adapt this question as you see fit. We'll start with Nate, then Tricia, and then Subadra.
All right. Well, in 1987, Bob Solow said that you see the IT revolution everywhere except for in the productivity statistics. And that was referred to as the Solow productivity paradox. And I think we're now at a place where AI is having a significant effect on the economy. But I don't think we're yet to that place where it's actually transforming the supply side of the economy and generating more productivity growth. So we're similar to where Solow was in the late 80s, but then in the mid 90s, it exploded. And I think we will see an explosion of productivity growth over time. What we are seeing now is an increase in demand associated with the investment that's necessary to put AI in place. Specifically, we're seeing investment in data centers, we're seeing investment in electrification and grid, we're seeing investment in the capital hardware, computer hardware that's necessary to run it, in the computer software, but it's more of a demand side phenomenon. And I think you also see that in the upsurge in recent years in US manufacturing construction. But I am reasonably comfortable that over the course of time, we'll have that infrastructure in place, we'll have the applications in place, and it will be widely enough adopted throughout the economy. But all of that takes time. I mean, even once it's inside the firm, you have to move from a place of kind of being an interesting curiosity to a place where it is really transforming the way that people do their jobs. And my instinct is that's probably still 3 to 5 years out, maybe closer to 5 than 3, before we really see that productivity explosion. But my instinct here is that AI's impact on the supply side, once we see its full effect, is likely to be comparable to or even greater than what we saw from the internet revolution. And that was something like a 0.5 percentage point to a percentage point on the level of productivity for 5 to 7 years. So I think that dividend is out there, but it's still a few years out there.
Yeah, and I definitely agree with sort of the 5-year strategy. I think PwC came out with a paper recently that said that they thought it would be like $15.7 trillion that are going to be contributed to the global economy by 2030 for AI. And, I think when you look at the innovation in healthcare, innovations in finance, I'm not sure that the SEC is going to allow us to do AI algos, but you never know. Hoping not. I guess, I'm not sure. Manufacturing, retail and e-commerce, there's just so many, applications. And that's when we're looking at transportation, on the defense side with automated planes. We're already seeing that in the Ukraine war with the drones. And, we've seen the sort of the new underwater drones, I guess, in lieu of submarines. So, there's definitely so many applications for it that I think, to your point, I agree with completely. It's like the internet revolution. It's going to be something that really transforms the way we do a lot of things that we've done in a different way for so long. And I don't know that we understand all of that at this point in time, and we obviously are concerned about the productivity issues and also the employment issues. But I do believe that a lot of those jobs that we were doing data entry, which will go away, will hopefully be used for much more interesting things in data science, emerging industries, etc. So I'm very, very positive on the AI revolution. So we're staying very close to that. That's for sure.
Yeah, I mean, I don't have a whole lot to add. I mean, only that I have started using, or I should say my team as well, a lot of these tools. I mean, our documents are, when I'm in research, we had editors. We don't use editors anymore. We use ChatGPT to edit our documents. We generate code from ChatGPT that we use. So something that would have taken us 3 weeks, takes us an afternoon sometimes to crank out if we have an idea that we want to implement. And I think the best sort of way, to describe AI, and I heard someone describe it to me this way, is that, when electricity was invented, people just couldn't envision all the different ways in which you could use electricity, and that's kind of how this is going to be. I mean, I think the use cases for AI is just going to be everywhere, and I'm almost certain that this discussion about AI, if we have it 5 years from now, is going to be very, very different than the sort of very rudimentary discussion we're having right now, because we're going to have our own AIs and AIs for AIs and assistants and the whole, gamut that I can't even kind of get my head around.
Wonderful. All I hope is that AI is not doing this forum and kicking me out of a job in 5 years.
That's most certainly going to happen, right? There's already.
No, absolutely.
I checked out an AI that you can generate a podcast with voice, the whole 9 yards. Absolutely. If you just give it text, it does a whole podcast for you.
No, I absolutely. So wonderful. So I want to kind of conclude with a brief question that has nothing to do with economics and markets. And the reason I'm going to open that up is because there are a lot of students in this audience, and a lot of them look to you as role models for shaping their careers. So for students today, perhaps more so than usual, perhaps it always has been this case, life looks uncertain along several dimensions. The AI thing itself is quite a twister. So I wanted to get your thoughts on how they should approach their careers. What's the principle? What insights? What advice do you have for them? So I'm going to go Subadra, Tricia, Nathan in that order. So feel free. It doesn't have to be very long. It could be a bumper sticker if you like, but whatever you think they should, that will help them in their careers.
Follow your passion. If you are going to pursue something, you've got to like what you're doing. So Don't do something because it's a fad or it's what your classmates are doing right now to graduate from school. But always ask yourself if you're happy doing what you're doing. I think that it's a cliche, but you do well when you enjoy what you're doing.
Yeah, I think that's absolutely true. I really love that because, one of my first bosses, when I got a job, I said, "What do you want me to do?" And he goes, "I want you to do what you're good at," which was an interesting thing. I think the other thing is, don't get caught up in brands. I mean, you're obviously at a brand at, NYU Stern, which is fantastic. But, when you're thinking about where you want to work, working at a smaller firm, a startup firm gives you so much knowledge and information that you can apply later on. I think people all want to go to the same thing in the US. That's what I've sort of garnered from experience. Everybody wants to go to the same firms. Maybe that's a good strategy, but I also think an equally good strategy is to show a little bit of, thoughtfulness about, going somewhere smaller. I know that a lot of my friends have ended up doing and having amazing careers, started at smaller firms, moved up, did multiple jobs as a result, didn't get sort of like, put into a box and ended up having these incredible careers. So, just think differently about, where you want to start your career. It's definitely not where you'll be ending your career.
My thoughts are very similar. I would say be passionate and be authentic. When I talk to folks that are early in their careers, sometimes I have this feeling that they're trying to mold themselves into something that someone else thinks of. Oh, you're going to be the perfect candidate. And it's just not authentic. What I want and what I always tell them is, don't tell me what you think I want to hear. Tell me about what you really think. Tell me what you're interested in. And I think that authenticity is consistent with driving the passion. In that, these careers, they're long and they're intensive. And if you don't get satisfaction out of the work you're doing, it becomes drudgery. So passion and authenticity are the two words that I'd emphasize. Find who you are and make yourself the best you can.
Wonderful. That's a great note to end this session. And on behalf of everyone at NYU, everybody on this panel, and everybody else here at NYU Stern, I want to extend a very warm thanks, gratitude to all the panelists. You guys have given us a lot to think about, a lot to chew on. I'm sure we'll be, thinking about and discussing these issues for quite some time to come. Once again, I know all of you have incredibly busy schedules, so we are very grateful that you took time out of your calendars to spend some time with us. I look forward to welcoming you to Stern again at some point in the not too distant future. And to everybody who attended, thanks again for coming. We hope to see you again at upcoming center events. And with that, I'm going to kind of end this panel discussion. Thank you once again, all of you.